topic that we would like to talk about, and that is the latest interest coming in arbitrage funds. Take a look at the sort of inflows that have come in this particular category of mutual funds. Arbitrage funds versus 2018 during the April to December period have actually surged in terms of inflows. So while during April to December 2018, it got roughly 1700 crore rupees from, investors like you and me, during April to December 2019, those flows actually increased to 34,100 crores. That's a huge uptick seen in the inflows for arbitrage funds. And compare that with what happened in equity mutual funds. There, the net inflows came down. Liquid mutual funds as well saw a decrease in the net inflows during the same period, in this year. So it's clearly arbitrage funds that's garnering a lot of attention. And even return wise, there you have it. That's the fund returns during March to December of 2019. And, if we just have to compare it with the large cap, mid cap and small cap fund, the arbitrage fund has actually delivered 4.6%. So it's been among the good performers as well. So that's, a trend that we are picking up. And to talk about what exactly are arbitrage funds, what sort of investors can, pick this fund category, we have with us today Mrin Agarwal, the founder and director of Finsafe Advisory. Mrin, thanks so much for joining in. What exactly are these arbitrage funds, and why is it that, investors lapped out these funds so much during April to December 2019? I mean, it was almost more than 30,000 crore rupees versus just 1,700 crore rupees. So what exactly happened?
I think it was basically the risk aversion. So we saw some of the ultra short-term funds and some of the shorter duration funds basically giving negative returns due to having some amount of credit risk in their portfolios. And due to that, I think investors did get spooked and they decided to move on to arbitrage funds, which are lower risk and also have the benefit of equity taxation over 1 year. Now, what are arbitrage funds? These funds typically have a minimum of 65% exposure to equities, but in form of arbitrage. So what does it mean? They buy a stock in cash and they also sell it in future. So it's essentially saying, I'm going to buy a stock at 100 rupees and I'm going to sell it at 105 or 106 in the future, and that trade is tied in on the date of investment. So when you are investing in this product, or when a fund manager is investing into arbitrage or doing arbitrage on a stock, they know exactly that for whatever their purchase price is, what is their sale price going to be, and that gain between the purchase price and the sale price is the return that the investor makes, which has been around 6.5% in the last 1 year.
Well, yes, that really has been the case. They've returned pretty well. So, Mrin, who would an arbitrage fund be suitable for? I mean, usually we say, that for an individual investor, you should have equity mutual funds because power of compounding, etc., etc. You should have a big chunk in large caps, and then, of course, mid caps and small caps. So where does an arbitrage fund fit in to an individual's mutual fund portfolio?
Well, arbitrage funds can be used by people who want to park money away for a year. It could be actually any period above 3 months is what I would say, but it works well for periods above 1 year because of the attractive taxation, the fact that it is taxed as equity, and the fact that there's no naked exposure to equities in the fund. It's only exposure through arbitrage. So anybody who has 1 year money to be parked away, I think it's a great product for them.
Okay, so you mentioned 1 year. You're saying that it is more of a short-term product. Now, we usually associate short-term products with maybe, something that has a fixed income exposure. So in this environment, Mrin, where we are seeing growth staggering, we are seeing inflation coming back, do you think an arbitrage fund would do well in this environment? Just to make it easier for our viewers to understand and just to sort of jog their memory, to educate them as well. Remember, folks, if inflation is coming back or is, high, the RBI will not cut interest rates. In fact, they may consider hiking interest rates. The whole of last year, you saw the RBI cutting interest rates, but this time around, they may pause on that. So, Mrin, wouldn't arbitrage funds, suit that as well?
I think it makes a lot of sense because arbitrage funds tend to do well when the markets are volatile. That's the equity markets. And given the fact that inflation is coming back and we may not see rate cuts happening, there is a fair chance, and given also the fact that the borrowing numbers could be higher and the fiscal deficit number could be higher, I think interest rates will certainly move up, and hence it probably makes more sense, at least for a 1-year exposure, along with favorable taxation, to be in an arbitrage fund over a ultra short term fund.
If we have to compare arbitrage funds to, let's say, a liquid fund, how would you pitch the two against each other? Because, while arbitrage fund has done better compared to the other equity funds, a liquid fund still has done better than an arbitrage fund. And of course, not to mention the convenience, right? Like, for example, if I'm an individual and I have money in my savings account, thanks to financial technology today, thanks to the abundance of apps, all I need to do is just with the click of a button, I can put some money in a liquid fund, earn that 2-3% extra than I would in a savings account. So there's that convenience as well of simple liquidity, of simple money being moved around from, my savings account to a liquid fund. So how do you pitch a liquid fund to an arbitrage fund, or do you think they're not comparable?
Well, I would say that liquid fund would work well if you have a holding period of less than 3 months. And I think that's where the differentiation really comes, that liquid would work well. And given the fact that the liquid category is really not taking any risky bets, I would say that liquid would work well for a shorter term period, which could be anywhere between 0 to 3 months. And arbitrage is something that you could look at if you're looking at periods above 3 months, basically.
So, Mrin, in what sort of a scenario would an arbitrage fund do well? And in what, economic scenario or market scenario would an arbitrage fund not do well?
So arbitrage funds do really well when there's a lot of volatility. And the arbitrage opportunities, I should say the arbitrage opportunities are more when the markets are volatile. Whereas when markets are falling, or if the markets are stable, the arbitrage opportunities, or even the spread might be very limited in those periods.
Okay, understood. So when you feel that you're going to be faced with a lot of volatility in the markets, and I think now, Mrin, is when we will be facing volatility, because we have the union budget as well that's going to come up, and I think the market's going to strongly react to any announcements by FM Sitharaman as well. So I suppose maybe an arbitrage fund would be a good idea to, keep in your portfolio. Okay, well, on that note, I would like to kickstart our Ask the Money Show segment. So calling out to all the viewers out there who've been watching our program, if you have any questions or queries on, be it arbitrage funds, on your portfolio, on any additions you like to make to your mutual funds, or even if you've not yet kickstarted your mutual fund journey but are interested in doing so, Mrin is right here. She's here to help all of you all out. Well, for now, let's take on board some email queries. By the way, the phone number is appearing on the top of your screens. 24990300 is where you can call in. But for now, let's just take some email queries. We have Mr. Khulla, who has written in to us saying, I have a significant part of my large cap portfolio in the ABSL frontline equity. Should I switch to another large cap fund considering its performance? Mrin, you've been joining us on the Money Show for some time now, and I can bet that you've as well heard some of our viewers ask this question very often, that I have my money in a small cap fund and a mid cap fund and it's fallen, or in this case, of course, a large cap fund, that's the ABSL frontline equity fund, and the NAV has fallen. So I suppose it's in your territory. We do know the problems that the entire ABSL family has faced. The entire AMC, a lot of the schemes have had some trouble in the last 1-2 odd years. That's not been the case for the long term, that's for sure. It's just in the last 1 year, if you look at the performance, it's fallen a bit. So in such a scenario, Mrin, what would you recommend, all our investors do?
Well, remember that all funds go through cycles. Honestly, if something is doing really well right now, there'll be a period when that's also underperforming. And I think ABSL Frontline Equity has seen this underperformance in the shorter term. It's to do with the fact also that the fund is pretty huge. But I think, it's like all funds go through cycles. And from what I understand from his query, I don't think that the holding has been for a very long-term period. So I would suggest him to stay put. I don't think that it makes sense to move into another large cap fund because of the short-term performance. But one thing that I noted was that he said that he has a significant exposure to the fund, and I would just suggest that he diversify his exposure between large and mid cap. Of course, that depends on his risk taking ability as well, but I think the point is that having a significant or a majority part of your portfolio in just one fund is a risk in itself, and you run the risk of underperformance, which is what he's seen. So I think he can stick on with the fund, but he really needs to look at diversifying as well.
All right, it's important to diversify your fund, like we have time and again said on the Money Show as well, and hence we keep introducing all these kind of categories as well for you, like the Arbitrage fund, because you need to ensure that you have a bit of flavor from every pocket of the markets to ensure that, if one thing comes crashing down, your portfolio as a whole does not suffer. Okay, let's take on board our next query, and let me once again remind our viewers, our phone lines are open. You can send in any questions or queries. 24990300 is the phone number. Ketan Wankhede writes into us saying, I'm 25 years old and have been investing in ULIPs since July 2018, and it is for a period of 10 years. He wants to know if the ULIP plan can give me more returns than an equity fund. So, Mrin, we know that a ULIP is essentially a combination of insurance as well as equities, but still, for the benefit of our viewers who may not be aware of this product, if you could give a brief introduction and, of course, answer Ketan's question. He already has a ULIP, but now he's wondering if that would be as lucrative as an equity fund. What would you, say to help him out?
So, ULIP, as the name suggests, it's unit-linked insurance plan, which means that it's run by an insurance company. So, what the insurance company does is that it, of course, covers the risk of your life, and it also invests the money. Now, what happens is that typically ULIP returns, which is the investor returns in ULIP, are quite low, and the reason being that over and above, whatever the fund has generated or whatever the investment has generated, over that there are a lot of charges. So the biggest charge over there is the mortality charge, which is to really cover the risk of your life. Then, of course, you have the fund management charges, you have policy administration charges, and there are a whole lot of other charges that are there. And it is due to these charges that the overall returns in ULIPs turn out to be very low as compared to equity mutual funds. So my preference would be for an equity mutual fund. And please remember that the role of insurance is really to cover the risk on your life. So you're better off taking a term plan to cover that risk and then investing your money into an equity fund.
All right, fair enough. So that's, and of course, not to mention, the tax component as well in a ULIP, which is allowed in deduction under Section 80C. Okay, we have Mr. Shivakumar joining us now on the phone line. Good evening, Shivakumar. What's your query?
I have some exposure to Franklin Templeton Ultra Short Fund.
Okay.
So it was showing a positive return of around 9% since last week.
Yes.
And last week suddenly it is showing minus 26%. Then when I inquired, I came to know that they had Vodafone Idea exposure.
That's right.
And that valuation they have made it to zero.
True.
So now it is minus 26%. I have about 4 lakh rupees in that fund. Now what do I do? I mean, should I wait and watch what will happen or?
Yes. Okay. Well, yeah. What they've essentially done is written down the entire value of Vodafone Idea, to absolutely zero. But I suppose, Mrin, and I don't know if you'll agree with me, the good thing of it is that suppose, let's say, Vodafone is given a breather, is given a fresh lease of life in any form. For Franklin, from here, it's only one way up. I suppose you could consider it that. If I have to look at the light at the end of the tunnel, I suppose. But yeah, I think a valid question, and I suppose Mr. Shivakumar will be asking it on behalf of all the other Franklin Templeton investors as well who've had their NAV values crash on account of this write down. What would you recommend such investors do? And also, if I'm not mistaken, Franklin has said that they have side pocketed the exposure. So what does that mean for investors like Shivakumar?
All right. So I think, the answer really depends upon do you need the money or not at this point in time. I understand you would have chosen an ultra short-term fund to basically park short-term surpluses. And as Mubina said, the money has been side-pocketed. So what a side pocket has been created, I'm sorry. So what that really means is that those units which are equivalent to the Vodafone holding have been put aside into another fund. And the moment the money comes back, of course, what it really means is that you are going to get your money back. To really answer your question whether you should hold it or not, well, I mean, honestly, whatever had to happen in the fund has already happened and you're already sitting on that loss. So if you really need the money at this point in time, yes, you don't have an option but to remove it. But if you can actually hold on for some time, because as of now, it's a more of a proactive action, because right now they have not really defaulted on any debt at this point in time. It's just that the rating has come down because of the proposed license fees that they need to pay. So I think if you can hold on, I think you should. But if you need the money, yes, you don't really have an option at this point in time.
Okay, all right. So I hope that will help you take your decision, Mr. Shivakumar. Okay, Narendra Shah from Kolkata is joining us now on the phone line. Good evening, Narendra. What's your query?
Yes, good evening, ma'am.
Good evening, sir.
Ma'am, I am having 3 balanced funds.
Okay.
Now it is a hybrid or debt equity, you can call equity and debt.
Sure, sure.
So one is ABSL hybrid and one is ICICI hybrid.
Okay.
And one is IDFC hybrid.
Okay.
All 3 funds I am holding since last 30 months, 2.5 years.
All right.
And the return I am getting only 2-3% annualized.
True.
So what I should do and how this poor return we can survive and invest?
Okay. Just a quick follow-up, sir. Firstly, do you have any other funds? And secondly, do you need the money right now?
No, I don't need money, but I am worried about my poor returns like 2%, 3% because I'm not even getting FD returns, FD interest rates.
Of course, absolutely. I understand your concern because today, even if you'll put it in a fixed deposit, even after cutting taxes, you'll still get 6% even though FD rates have fallen. And I'm assuming he does not have any other funds in his portfolio. He just has these 3 hybrid funds where he's just getting 2 to 3% of an annual return. So, Mrin, what would you recommend Narendra ji do?
I would suggest that he holds on. 2.5 years is a very short period at this point in time. A typical holding for a balanced fund needs to be at least 5 years. So I still think that, while he's invested for 30 months, I think he should still hold on for another 30 months. And I think the funds that he's mentioned are good funds as such, but he just needs to hold on right now. I don't think that he should exit for sure.
Okay, so sir, don't exit. Yes, so, the returns are not exactly attractive, but you bought it 30 months ago, and since then we know that the markets as well have had their own fair share of ups and downs. So be patient. Like we say, with mutual fund investing, you need to invest for the long term because that's where you're able to make a good amount of money. So just be patient and stay put. That's Mrin's advice. Okay, folks, with that, we'll not be able to take any more queries. But, Mrin, I'll request you to stay on because we will take a very short break. And when we return, we're going to be talking about a new product on the block. Well, not exactly new, but a new tranche is opening up, and that's of the CPSE ETF. What exactly is it? And what's Mrin's recommendation for all the individuals out there? We will be talking about that when we return.